Summarizing chapter 12, we have corporate valuation and financial planning tied together because what we do is we do our projections, we do evaluation, we look at our balance sheet income statement and see how it meets or does not meet our objectives. If it does not meet our objectives, then we have to go back again and do a revision. So this planning process that involves projections, evaluations, and iteration is very common. We saw and learned two new tools, the AFN, which is additional funds needed, and also the SGR, sustainable growth rate or self-supporting growth rate, are useful just to look at where we are right now and what percent can we grow without straining our balance sheet, that's the SGR, or how much do we want to grow and how much cash will we need to raise in order to comfortably maintain our current balance sheet relationships. We also did forecasting on an iterative basis. We started with a base case, saw that it was not good enough, changed assumptions and ran it again, which magically got better and met our needs. And finally, we looked a little bit at the ratios and how we're a little bit simplistic, how everything's linear, and that not all things are linear. The two examples that we looked at were inventory, which would definitely not double as we double sales, and the other is a factory. We would add increments of fractional factories. We would likely run overtime or different shifts until we could justify building a new factory, and then we would do so. So even though linear is not the case, we can find ways to build that in if we want to refine our model. So one last point is that in the downloadable files from the student resources, you'll find all the spreadsheets.